$87 silver. The physical squeeze is worse than we believed. While the world watches stock markets and crypto, a silent crisis is unfolding in the silver market. Industrial giants are quietly panic buying. Government vaults are being drained faster than ever recorded. And the paper contracts? They promise 250 ounces for every single physical ounce that actually exists. Major refineries are now reporting something they've never seen before. Delivery delays stretching into months. Premiums exploding to historic levels. And here's what nobody's telling you. The math stops working at $87 because at that price, everything changes. Welcome to Financial Inspection. If you've built your career on making informed decisions, if you've learned that the most critical information rarely comes with fanfare, then you're in the right place. We'd be honored if you'd subscribe to this channel. Think of it as keeping a trusted analyst on retainer, except it costs you nothing. Just tap that subscribe button below. We're curious, where in the world are you watching this from? Are you in New York, London, Singapore, Lagos, Mumbai? Drop your city in the comments. Because what's happening in the silver market right now, it's not a local story. It's a global structural shift. And you're about to understand exactly why. In the first week of January 2025, something unusual happened in silver markets that most investors completely missed. A procurement manager at a major solar panel manufacturer in Germany placed a routine order for 50,000 ounces of physical silver. The response from his supplier made him pick up the phone immediately. 12 weeks delivery, and we need payment up front. 12 weeks. For a metal that, according to every financial screen in the world, was trading freely at around $30 per ounce. This wasn't an isolated incident. Across 3 continents, industrial buyers were discovering the same troubling reality. The silver they could see quoted on their Bloomberg terminals, the silver trading actively on the COMEX exchange, and the silver they could actually touch and receive were becoming 2 entirely different things. The numbers told a story that seemed impossible. On paper, silver looked abundant. Futures contracts traded by the millions of ounces. Price discovery happened smoothly. Liquidity appeared deep. But in the physical world, a different reality was emerging. The United States Mint, one of the world's largest silver coin producers, had already suspended sales twice in the previous 6 months. Not because of lack of demand, but because they couldn't source enough physical metal. The premiums told the real story. Normally, a 1-ounce silver coin might trade at $2 to $3 above the spot price, a reasonable manufacturing and distribution markup. By early 2025, those premiums had exploded to $8, $10, even $12 per ounce in some markets. That meant buyers were paying $42 for an ounce of silver that their screen showed was worth $30. A 40% premium wasn't a market inefficiency. It was a market screaming that something fundamental had broken. The major vaults painted an even more concerning picture. COMEX inventories, the primary price-setting mechanism for global silver, had dropped 40% from their 2020 peaks. Registered silver, the amount actually available for delivery, had fallen even more dramatically. In London, the traditional heart of physical precious metals trading, vault operators were reporting something they'd rarely seen: net withdrawals month after month, with no signs of slowing. Meanwhile, the paper market continued as if nothing had changed. Analysts estimate that for every ounce of physical silver in existence, there are between 100 and 250 paper claims. Futures contracts, allocated accounts, ETF shares, and various derivatives all representing ownership of the same underlying metal. This leverage had existed for years. It's how modern commodity markets function. But leverage only works when most people don't ask for delivery simultaneously. And that assumption was beginning to crack. A mining executive in Peru explained the dynamic simply. We produce 20 million ounces per year. Half goes to long-term industrial contracts that were signed 2 years ago. A quarter goes to regional fabricators. And the rest? It's spoken for before it leaves the refinery. The paper market assumed infinite substitutability. If you held a futures contract, you could always find physical metal to deliver against it. The physical market was proving otherwise. What made this particularly dangerous was how invisible it remained to conventional analysis. If an investor checked silver prices, they saw a number: $29.50, $31.20, whatever the spot price happened to be. That number reflected the paper market, the world of contracts and promises and financial instruments. It didn't reflect the reality that a business needing 1,000 ounces for manufacturing might wait 3 months and pay 35% above that quoted price. The disconnect had historical precedents. In 1980, physical silver briefly became almost impossible to obtain at any price, as the Hunt brothers' attempted corner collided with industrial demand. In 2011, as sovereign debt crises intensified, premiums spiked and delivery delays stretched for weeks. But those were temporary dislocations, short-term squeezes that resolved as speculative pressure eased. What was emerging in 2025 looked structurally different. This wasn't driven by speculators cornering supply. It was driven by fundamental demand exceeding fundamental supply, month after month, with no equilibrium in sight. And here's what made the $87 projection more than mere speculation. At current prices, the paper market could maintain its illusion. Most futures contracts were cash settled. Most ETF shares never converted to physical. The system worked as long as most participants played by the paper rules. But as physical tightness increased, as premiums widened, as delivery delays lengthened, more and more participants would inevitably demand actual metal. And when enough people simultaneously realized that 250 paper claims existed for each real ounce, the mathematics would force a repricing that had nothing to do with technical analysis or sentiment, and everything to do with physics. You cannot deliver what does not exist. In a boardroom in Shanghai, an automotive engineer held up a small component no bigger than a thumb. "This single part," he said quietly, "contains 1.2 grams of silver, and we cannot build an electric vehicle without it." He paused. "We're projecting 12 million units next year. That's 14,400 kilograms of silver, just for our company, just for this one component." Then he added the sentence that changed the entire meeting. "And we have no substitute." This scene was repeating itself across industries worldwide, not with panic, not with drama, but with the cold realization that modern technology had created dependencies that few executives had fully understood. Silver had become the invisible metal, essential everywhere, replaceable nowhere. A solar panel manufacturer in Arizona ran the numbers and discovered something unsettling. Each utility-scale solar installation required approximately 10,000 ounces of silver per megawatt. The ambitious renewable energy targets governments had announced worldwide would require 1.2 billion ounces of silver by 2030. Just for solar, just for the projects already announced. Current annual mine production? Roughly 830 million ounces. For all uses combined, the mathematics didn't balance, and solar was only one sector. In electronics manufacturing, silver's unique combination of electrical conductivity, thermal management, and reliability made it indispensable. Smartphones, computers, servers, telecommunications equipment, every device that powered the digital economy contained silver in dozens of microscopic applications. The medical industry had quietly become one of silver's largest consumers. Antibacterial wound dressings, surgical instruments, water purification systems, and advanced medical imaging equipment all depended on silver's unique properties. Then came the explosive growth in electric vehicles. A conventional internal combustion vehicle might contain 15 to 30 grams of silver, primarily in electrical contacts and switches. An electric vehicle required 25 to 50 grams. Some luxury models exceeded 80 grams, and the charging infrastructure required even more. With global EV sales projected to reach 40 million units annually by 2030, the single sector would consume over 2,000 tons of silver per year, double what the entire automotive industry used just 5 years earlier. But here's where the story took a darker turn. Unlike gold, which is primarily mined as a primary product, approximately 70% of silver comes as a byproduct of mining other metals, zinc, lead, copper, and gold operations that produce silver almost incidentally. This created a devastating economic reality. When silver prices rose, primary silver mines could increase production. But 70% of supply came from operations where silver was secondary, where production decisions were based on zinc prices, copper prices, lead prices, not silver. A copper mine in Chile didn't increase production because silver hit $40. They increased production when copper hit $4.50 per pound. Silver supply was largely unresponsive to silver demand. The numbers were quietly alarming. From 2015 to 2024, despite rising industrial consumption, global mine production had essentially flatlined, hovering around 830 million ounces annually. Some years slightly higher, some slightly lower, but no meaningful growth. Meanwhile, industrial demand had climbed from 490 million ounces in 2015 to over 650 million ounces by 2024, and projections showed it reaching 800 million ounces by 2028. The gap was being filled by above-ground stockpiles, inventories that had accumulated during decades when silver supply exceeded demand. But those stockpiles were finite, and they were depleting rapidly. A metallurgist in London explained the overlooked constraint. Ore grades have been declining for decades. 20 years ago, a decent silver mine might produce 300 grams per ton of ore. Today, many operations are mining 150 grams per ton. You're moving twice the rock for the same amount of metal. Lower grades meant higher costs. Higher costs meant marginal operations became uneconomic. Uneconomic operations closed, supply contracted further. Recycling offered limited relief. Unlike gold, where approximately 90% gets recycled because it's primarily used in jewelry and investment, silver's industrial applications often consumed the metal. Literally. Silver used in photographic film, batteries, chemical catalysts, and many electronic applications couldn't be economically recovered. It was simply gone, dispersed into landfills or trace concentrations too small to justify recovery. Current recycling supplied roughly 180 million ounces annually, nowhere near enough to close the deficit. The Silver Institute's projections were stark. 2024, 200 million ounce supply deficit. 2025, projected 240 million ounce deficit. 2026, estimated 280 million ounce deficit. Every year the world was consuming 250 million more ounces than it was producing. For perspective, the entire COMEX registered inventory. The physical silver actually available for delivery against futures contracts stood at approximately 40 million ounces, 1.5 months of the global deficit. Industrial buyers were responding the only way they could: long-term supply contracts at fixed prices, vertical integration into mining operations, substitution research that, so far, had yielded few viable alternatives. A purchasing director at a German electronics firm summarized the situation bluntly. 5 years ago, I ordered silver spot, delivery in 2 weeks. Today, I negotiate 12-month contracts and pray the supplier can actually deliver. This isn't a commodity market anymore. It's a managed scarcity. The question wasn't whether prices would rise. The question was, what would break first? Would industrial buyers bid prices up until demand destruction occurred? Would solar installations slow because silver became prohibitively expensive? Would the paper markets maintain their illusion until a delivery failure forced recognition? Or would something else, something unexpected, trigger the repricing that mathematics demanded? Because at $30 per ounce, with structural deficits approaching 300 million ounces annually, the system wasn't approaching equilibrium. It was accelerating toward crisis. And the industries that powered the modern economy were about to discover just how dependent they'd become on a metal most people never thought about. On October 22nd, 2024, something happened in Kazan, Russia, that received almost no coverage in Western financial media. At the BRICS summit, a single briefcase was placed on a table. Inside that briefcase were not documents, not digital presentations, but physical samples: gold, silver, platinum, palladium. The message was unmistakable. This, a Russian economic advisor stated simply, is what real money looks like when paper loses credibility. The room fell silent. For decades, the global financial system had operated on a fundamental assumption that confidence in fiat currencies, particularly the US dollar, would remain essentially infinite. That assumption was quietly unraveling. Central banks worldwide were speaking through their actions, not their words. In 2024 alone, central banks purchased over 1,000 tons of gold, the second highest annual total in history, and notably, these purchases were concentrated among nations actively seeking alternatives to dollar dominance: China, Russia, India, Turkey, Poland, Singapore. The pattern was unmistakable. But here's what the financial press had completely missed. While attention focused on gold, a parallel conversation was happening about silver. A monetary strategist in Beijing had run calculations that changed internal discussions. Gold is the monetary anchor, he explained to senior officials. But silver has something gold lacks: industrial indispensability combined with monetary history. The logic was elegant. Any new currency system needed credibility. Backing by tangible assets provided that credibility, but those assets needed to serve dual purposes in a modern economy. Gold-backed currency, but served limited industrial function. Silver-backed currency, and was simultaneously critical to solar energy, electronics, electric vehicles, and green technology. A commodity-linked currency based partially on silver would be backed by something the global economy genuinely needed, not just a monetary tradition, but an industrial necessity. Internal Chinese documents, later leaked, revealed proposals for a transitional monetary basket, where silver would represent 15-20% of the backing, not because of its monetary history, but because of its strategic industrial importance. The geopolitical dimensions were deepening. Mexico, Peru, China, Poland, Russia, Australia, Chile, and Bolivia controlled approximately 75% of global silver mine production. The United States, despite being the world's largest economy and military power, produced less than 3% of global silver supply. A supply chain analyst in Washington had briefed congressional staffers on a scenario most found difficult to believe. If silver becomes monetarily critical, she explained, we face a strategic vulnerability. We control neither production nor refining. We are entirely dependent on foreign sources for a metal that powers our military technology, our renewable energy transition, and potentially the next monetary system. The briefing was classified and forgotten, but in other capitals, similar analyses were driving very different conclusions. Russia and China had spent a decade diversifying away from dollar reserves, accumulating gold, establishing alternative payment systems, building parallel financial infrastructure. Silver fit perfectly into this strategy. It was undervalued relative to industrial demand. Western financial institutions held large paper short positions, and physical supply was concentrated in nations either neutral or hostile to Western monetary dominance. A financial historian noted the eerie parallel to 1971. When the United States abandoned the gold standard, it wasn't because gold had lost value. It was because the promises exceeded the physical reserves. The paper claims multiplied faster than the metal itself. In 2025, silver faced an identical mathematical problem, but this time with industrial demand creating a hard floor under any monetary premium. The currency debasement cycle was accelerating. The U.S. national debt had exceeded $36 trillion, with deficits running over $2 trillion annually, and no political will to reduce spending. The European Central Bank had resumed quantitative easing after a brief pause. Japan's debt-to-GDP ratio exceeded 260%. China was managing a real estate crisis that threatened its banking system. Every major economy was trapped in the same dynamic: too much debt, too little growth, and only one solution politically palatable: devalue the currency through inflation. Real interest rates, adjusted for actual inflation rather than official statistics, were deeply negative across developed markets. In this environment, hard assets weren't speculation. They were survival. But silver offered something unique. Gold was the traditional monetary safe haven. But it was expensive, primarily monetary, and governments had spent decades conditioning populations to view it with suspicion. Silver was different. At $30 per ounce, it remained accessible to ordinary people. Its industrial uses provided fundamental value divorced from monetary sentiment, and its historical role as the people's money resonated in cultures spanning millennia. A quiet shift was occurring in wealth preservation strategies. High net worth individuals in currency unstable regions, Argentina, Turkey, Lebanon, Nigeria, were increasingly allocating to physical silver, not as speculation, but as portable, divisible, universally recognized value. One wealth manager in Dubai explained his client conversations. They ask me, if the system resets, what holds value? I tell them, things people need and cannot print. Silver qualifies on both counts. The institutional positioning was equally revealing. Commitment of traders reports showed commercial short positions, primarily banks and financial institutions, at historically elevated levels. These weren't speculators betting on price declines. These were entities with obligations they'd promised to fulfill, paper silver they'd sold but might not be able to deliver. If physical supply tightened further, if industrial buyers demanded delivery, if monetary demand emerged simultaneously, those short positions would become catastrophic liabilities. The BRICS currency discussions continued behind closed doors. Whether a new currency system actually emerged remained uncertain. Whether it included silver backing remained debatable, but the mere discussion changed calculations. It introduced a scenario where silver wasn't just an industrial commodity or investment asset, but a potential component of the next global monetary architecture. And if that happened, if even 5% of global reserves shifted toward silver, if central banks began accumulating silver alongside gold, if monetary demand combined with industrial scarcity, the $87 projection would look conservative. Because the current price reflected only industrial supply and demand, it didn't reflect monetary premium. It didn't reflect strategic hoarding. It didn't reflect the possibility that silver might become what it had been for 5,000 years of human history: money. And once that perception shifted, once silver reclaimed even a fraction of its monetary role, everything changed. The question wasn't if the system would reprice silver. The question was what would trigger the recognition, and who would be positioned when it happened. A risk analyst in Singapore sat before 3 computer screens, each displaying a different scenario model. All 3 models, built on different assumptions, different data sets, different methodologies, converged on the same conclusion. The current price, she said to her team, is mathematically unsustainable. Something has to give. The only question was what would break first, and how violently. She labeled her scenarios simply: gradual adjustment, accelerated dislocation, system crisis. Each told a different story. Each led to the same destination, just at different speeds. The gradual adjustment scenario assumed rational actors in functioning markets. Industrial buyers would slowly recognize the structural deficit. They would incrementally increase inventory holdings and extend supply contracts. Paper market participants would gradually demand more physical delivery. Premiums would rise steadily, and prices would climb over 24 to 36 months as reality overtook perception. In this scenario, silver reached $87 by late 2027. Not through panic, but through systematic repricing as industrial necessity overwhelmed paper market illusions. Companies with inadequate supply chains would face production disruptions. Solar installations would slow as input costs rose. Electronics manufacturers would absorb margin compression, but the transition would be manageable. Investors who positioned early would see substantial returns, but without drama, without crisis, without systemic failure. This was the optimistic case. The accelerated dislocation scenario assumed a trigger event. Perhaps a major solar manufacturer would default on a futures contract, unable to source physical delivery. Perhaps a bullion bank would fail to meet redemption requests from a large ETF. Perhaps a mining operation would experience unexpected production failures. Any single failure point could cascade. Once market participants recognized that paper promises exceeded physical reality. Once confidence in the derivatives market cracked, the repricing would accelerate dramatically. In this scenario, silver could move from $30 to $87 in 6 to 12 months. Not smoothly, but in violent bursts punctuated by trading halts, forced liquidations, and delivery failures. Industries dependent on silver would face immediate crisis. Solar projects would be canceled mid-construction, electronic supply chains would seize, automotive manufacturers would halt EV production lines. The economic disruption would extend far beyond silver markets. It would impact renewable energy targets, technology manufacturing, and the broader green economy transition. Investors positioned correctly would see extraordinary returns, but the systemic stress would be severe. The system crisis scenario was the one that kept analysts awake at night. This assumed that silver's physical squeeze coincided with broader monetary system stress, a sovereign debt crisis, a major currency devaluation, a banking system failure, or geopolitical conflict that triggered safe haven demand. In this scenario, industrial demand and monetary demand would collide simultaneously. While physical supply remained constrained and paper markets collapsed under the weight of their own leverage, silver wouldn't gradually climb to $87. It would gap violently through that level as markets struggled to discover a clearing price. $50, $75, $125, with massive volatility as the system searched for equilibrium. But the implications would extend far beyond silver prices. This scenario would signal broader systemic failure, not just in commodity markets, but in the financial architecture itself. Industries would face not just supply shortages, but financing difficulties. Credit markets would seize, and the economic disruption would be measured not in quarters, but in years. The analyst assigned rough probabilities. Gradual adjustment, 40%. Accelerated dislocation, 45%. System crisis, 15%. But she noted something crucial. Even in our best case, she wrote in her report, silver reaches 87. The only variable is timeline and volatility. The vulnerability mapping revealed which sectors faced the greatest exposure. Solar manufacturers with thin margins and no hedging strategies would be devastated. A 50% increase in silver costs would eliminate profitability on projects already contracted. Electronics companies that ordered silver on short-term spot contracts rather than long-term agreements would face immediate margin compression or production delays. Automotive manufacturers racing to meet EV mandates would discover that government policy had assumed commodity prices that no longer existed. But the financial sector faced perhaps the greatest risk. Banks and institutions holding large short positions in silver derivatives had built those positions, assuming infinite physical substitutability, assuming that paper contracts were interchangeable with physical metal, assuming that delivery demands would remain minimal. If those assumptions failed, if even 10% of paper contracts demanded physical delivery simultaneously, the losses would be measured in billions, potentially triggering counterparty failures and systemic financial stress. A derivatives trader in London had calculated his institution's exposure. We're short 50 million ounces in various instruments, he admitted privately. We have access to perhaps 2 million ounces of physical metal. If this goes wrong, we're not just losing money, we're bankrupt. He wasn't alone. For businesses, the strategic response was clear. Secure physical supply now, while available. Negotiate long-term contracts even at premium prices. Research substitution possibilities, while acknowledging most wouldn't work. And build inventory buffers that would have seemed excessive 2 years ago. A procurement director at a major manufacturer explained his new strategy. We used to hold 2 weeks of silver inventory. We're moving to 6 months. Yes, it ties up capital, but capital means nothing if we can't produce. For investors, the positioning framework was more nuanced. Physical silver offered direct exposure, but came with storage costs and liquidity constraints. Mining equities provided leverage, but carried operational and jurisdictional risks. Silver streaming companies offered royalty exposure without operational risk, but traded at significant premiums to net asset value. ETFs provided liquidity, but faced the same physical delivery questions that plagued the broader market. The sophisticated approach involved diversification across vehicles, with heavy bias toward physical holdings and producers with politically stable operations. But here's what conventional investment analysis was missing. This wasn't primarily an investment opportunity. It was a supply chain crisis that happened to create investment implications. The 87 price target wasn't speculation based on technical charts or sentiment indicators. It was the mathematical consequence of structural forces already in motion. Industrial demand exceeded supply by 250 million ounces annually. Above-ground inventories were depleting. Paper markets had created 250 claims for every physical ounce, and no mechanism existed to rapidly expand supply. At some price, demand would be destroyed, either through industrial substitution or economic recession that reduced manufacturing. At some price, supply would increase, either through higher-cost mines becoming economic or through increased recycling. At some price, the paper and physical markets would find equilibrium. Every analysis, using different methodologies and assumptions, placed that equilibrium price between $75 and $120 per ounce. $87 wasn't a target. It was a central estimate of where physics and economics would force the market. A veteran commodities analyst summarized the situation for institutional clients. For 50 years, we've operated commodity markets on the assumption that paper and physical are interchangeable, that leverage can expand indefinitely as long as most participants accept cash settlement, that supply will respond to price signals. Silver in 2025 is demonstrating that all three assumptions can fail simultaneously. What happens next isn't a market call. It's a mathematical inevitability. The only questions are timing and volatility. The warnings were being issued, but few were listening. Financial media remained focused on stocks and cryptocurrencies. Government policymakers were preoccupied with inflation and recession fears. And most market participants continued operating as if the system would function as it always had. But in procurement offices, risk management departments, and strategic planning sessions, a different conversation was occurring. A conversation about what happens when critical materials become scarce, when paper promises collide with physical reality, when decades of market leverage unwind, and when the price of ignorance is measured not in percentage returns, but in production lines shut down, in strategic projects abandoned, in technological transitions delayed. The silver market wasn't experiencing a bubble driven by speculation and sentiment. It was experiencing the early stages of a structural repricing driven by mathematics and physics. And those forces, unlike market psychology, were not subject to debate, only to recognition. The question facing every decision maker, whether business executive or investor, was simple. Would they recognize the reality before the crisis or after? Because the mathematics guaranteed one thing: recognition was coming. The only variable was cost.